Hello, and on this episode of the Mortgage and Protection Podcast, we have Paul here from Henchurch Lane to explain how a buy-to-let portfolio mortgage works. It's great to chat with you, Paul. How's it all going?
Very smoothly, Tessa. How's it going your end?
I'm very glad to hear that. And yes, all good to this end. Thank you. So let's get straight into these questions that we've got here then. So,
Unfortunately.
first of all, this is a good question to start with. What is the definition of a portfolio landlord in the UK?
Okay, so in the UK, a portfolio landlord is someone who owns four or more mortgaged buy-to-let properties. Okay, so it's key to remember that it doesn't matter how many buy-to-let properties you own in total, it's only the ones that you have a mortgage on. If you have a mortgage on four of those properties or more than four of those properties, then you're going to fall into the portfolio category for any further applications that you do. So if you apply for a mortgage on another property, at that point you'll be viewed as a portfolio landlord. It's completely irregardless of your residential property. It's only investment properties. If you had 30, it wouldn't make you a portfolio landlord. It would only make you a portfolio landlord if four of them or more had a mortgage on them.
Right. Okay. Well, clearly explained there. So four or more. I think that's the key there, isn't it, to
Yeah,
remember?
yeah. Did you
Okay.
did you get that from the answer? Yeah.
Definitely four or more. So let's follow
Good.
on with this next question then. How does a mortgage for a portfolio landlord differ from a regular buy-to-let mortgage? So that kind of continues on.
Yeah, it does. So after the definition, how does it differ? I mean, I could talk for hours on the differences because there are so many,
Mm.
and I'll try my best not to ramble on. So if we look to just bullet point a few of the main points that are likely to come up as differences, hopefully that will help people. So lenders, a little bit of an explanation. Lenders are going to treat these applications differently from smaller scale landlords. Let's say if you own one or two, because there's an additional risk there and there's an additional financial management involved with multiple property portfolios. So they will be viewed differently from lenders, and they'll look at the entire portfolio. So if you owned one or two and you're buying a third, going to look at the whole portfolio. It's not just subject to that particular, be across the whole portfolio with a view to see the kind of overall health of the property business as a whole, rather than just on that individual basis. So because of that, these kind of applications, that it's usually going to result in harsher criteria. It
Mm.
could mean a restricted loan to value, which in turn means a higher deposit. And they can come with things like higher fees, higher interest rates, and that's all due to the additional risk and the additional work that comes with these kind of applications. On top of that, the underwriting process itself is likely to be more arduous because the lender is going to want more documentation, and because they're looking at a bigger portfolio. Let's say, for argument's sake, they're looking at 10 properties rather than one property,
Mm.
because they're in the background. Naturally, it's gonna be more long-winded and it's going to be more expensive. It sounds pretty negative, but you know, actually, it's all for good reason. And if you are in a position where you've got that many properties, then actually it's almost a professional business, and they need to make sure there's a good backing behind that. So they're not just going to look at it, in isolation. They're going to look at it at the bigger picture.
Which you can understand there. So, some points to remember as well. And with all that in mind, actually, it leads us on to the next two questions. Let's go into a little bit more detail now. So, what are the eligibility requirements for a portfolio landlord mortgage? What documentation is typically required to apply for one of these?
Okay, so eligibility is going to differ from one lender to the next. That's similar across the board for mortgages, but you can expect to see certain criteria crop up quite commonly with these applications. So there's a good chance a minimum, put my teeth back again.
Minimum.
There's a minimum personal income that's going to be required, and most commonly that's £25,000. So some lenders will have slightly more, some lenders won't have that at all, but a really common criteria for buy to let and portfolio buy to lets is as a minimum personal income of £25,000. They're going to want to see some kind of landlord experience. Generally that's going to be 12 months in that space, and the likelihood is if you've got 4 buy to lets at least, then you're going to have 12 months worth of experience. So you probably have that one ticked off. Each lender is going to have their own credit scoring rules. So as always, the better your credit, the better rate you're likely to be able to secure, and how competitive that is. So it's always good to keep an eye on that. Every lender is going to apply some kind of stress test that's going to determine, the maximum loan size that you can achieve for that property. So it's worth being mindful that it's not a case of just going to any lender and getting the same outcome. Everyone's going to stress it in different ways. Document wise, obviously, all mortgage applications come with documentation. You've got your usual stuff, which is your income proof, your identification, your bank statements. That's all going to be required. But with these applications, because they do go a bit more in detail, you're going to need to provide additional, more in-depth documentation. So things like a business plan or maybe a cash flow forecast. That's going to be something they ask for. Something like a portfolio schedule, right? So they're going to ask you about details of your background properties, things like the value of them, the rental income, the loan size. All of those things are going to be something that they want to see a schedule for. An asset and a liability breakdown as well. So they're going to be looking a little bit more in detail in terms of the overall picture as an investor. And on top of that, if you're employed, normally you just provide pay slips. But because you've got a property business that you are obviously getting rental income from, there's a good chance that even if you are employed, they won't just ask for pay slips for evidence of income. They're going to ask for SA 302s or tax returns, which show the rental income that's being declared from that property portfolio in the background as well. So everything's just that little bit more than it would be if you were buying a property for yourself or buying your first couple of buy-to-lets.
Okay, well, thank you for the breakdown there. Hopefully that all makes sense. Now, with the next question, you've covered the minimum. So, how many properties can be included in a portfolio landlord mortgage? I think it was four or more. Is remembered that one. Is there a limit? Is there a maximum amount?
Okay, so it depends how you phrase that. So yeah, you're perfectly right. The minute you've got 4 mortgaged buy-to-lets, that's the minimum requirement. So you'll automatically fall into that classification. But there aren't really any maximums from, let's say, from a perspective. If you're a property landlord and you want to grow a portfolio of 100 properties, you could do that, and they could all have mortgages. So there aren't really any maximums in that sense. However, each individual lender could potentially apply a maximum to each individual client. So let's say, Tessa, you had 8 properties on a buy-to-let basis and you had them all with the same lender. At the point where you go 9 and 10, they might start saying, look, the exposure to you personally is now getting quite risky. So they might enforce a maximum of 10 properties per person. But at that point, if you had put them all with one lender and you came to me to get your next one, I would just place it with a different lender and you'd be fine.
Okay, that's a lot to juggle, isn't it? 10 properties.
It is. We deal with people with 40 plus properties. So,
Wow.
at this point, they've got actual workforces working for them because there's so much work involved with running that. Or obviously, you'd hire an estate agent or a letting agent to manage those properties for you, because it can become quite time consuming.
Yeah, I can imagine there. Wow. Okay, well, let's move on then. So, do you need to put down a deposit for a portfolio mortgage? How much deposit do I need for a buy-to-let portfolio mortgage?
Yes, you will do. Minimum is commonly 25% for most buy-to-lets in general. But, as we mentioned previously, because they look at the bigger picture, because they're looking at the portfolio and stressing that, and because the borrowing generally for a buy-to-let is driven by the rental income, it's difficult to say, what the minimum amount would be without seeing the portfolio, without seeing the property and what rental that's going to drive. But you could get a a portfolio landlord mortgage with a 25% deposit. But there could also be instances where it might need to be much more. And we've had particular circumstances where it's needed to be as much as 50% because of those things in the
Right.
background. So it's worth bearing in mind. It's not as simple as just answering that. It's a case by case basis.
Okay, yes, something to bear in mind there then. So, moving on, people would also like to know again, I'm not sure whether you've got anything else to add here. So, how do lenders assess the affordability of a mortgage for a portfolio landlord?
Right. This is a really okay. This is really technical, actually.
Okay.
It's interesting to know if people are genuinely out there asking this question, because
Mm,
I was probably doing mortgage broking for about 3 years before I actually understood the calculation
right.
myself. But on a really basic level, the potential rental that you get from a property, that, let's say, that 3-bed terrace is going to generate £1,500 a month rental income. That's the figure that's going to drive how much you can borrow.
Mm,
Okay, it's as simple as that on a very basic level. But if you want to get technical and okay, how does 1,500 get you to that? Then it is quite difficult to explain. It's what they
mm,
will use is something called an ICR, which is an interest cover ratio. Okay, now anyone that's probably a portfolio landlord has probably come across that ICR before, but
mm.
the easiest way to explain it is probably by giving you an example. So a lender is going to apply a stress rate to the equation. Now, that isn't necessarily going to be the rate you get on your mortgage. Let's say you get a buy-to-let mortgage and it's 5%. The lender might stress that at 6%. And the reason they do that is because obviously rates do fluctuate. Okay. So
Mm.
they're going to have this figure that they determine what is the stress test that the stress rate that they apply to the deal. Okay. So let's say their stress rate in this instance, you're looking to secure a deal and it's the stress rate is 6%.
Okay.
Then they're then going to apply a coverage amount to ensure that you can cover things like rental voids and maintenance costs, right? So
Mm.
getting the rental amount isn't quite going to cover those voids or isn't going to cover those maintenance costs that you've got. So they're going to apply a percentage above that, and a common coverage is 145% for a portfolio landlord.
Right.
Some buy-to-lets you might get 125%. It can go all the way up to 165, 175% coverage. Okay, so without getting too granular, let's say you wanted to borrow £100,000. If you stress that at 6%, then the annual interest that you're going to get from that is £6,000. £500 a month interest only, £6,000 over the 12 months, right?
Mm.
So you've got that £6,000. That's 100%. They want 145% of that, which annually is £8,700. Quick maths. So if you divide that by 12, because obviously that's the amount of months in the year, then you're left with a figure of £725. Okay. So that's £725. If you want to borrow 100 grand, if your property that you're buying can be rented out for 725 a month, then you can borrow 100 grand.
Right.
Yeah.
Okay.
If that figure was 750, then to borrow 100 grand, you'd have to get £750 rental income from the property. Okay. So as
Right.
long as that figure is where it needs to be, or you're going to get more than that figure on the rental, you're going to be able to borrow that loan. And that's how the calculation is crunched in the background. But that's all well and good, but every lender is going to have a different stress rate and they're going to have a different coverage amount. So every lender is going to offer you a different amount based on your particular circumstances and the property that you're buying. So
Okay.
you need to speak to a broker to work that figure out.
Okay. Well, I'm glad you did the maths there, but I think I was
Did it
following.
make, did it make
Hopefully,
complete sense to you, Tessa?
it did. You broke it all down really well. Hopefully, the listener, anyone watching this, hopefully that makes sense as well. But the beauty of this is you
Confused
can go
myself.
back and rewatch or re-listen. Um, right, we have 3 questions left, so let's move on to the next one here. I think you've touched on this already, actually. So, does a
Yeah.
portfolio mortgage have to be through one lender, or can it be different lenders for individual properties?
Yeah, so subject to criteria, you can apply to a different lender every time you look to add an additional property to your portfolio.
There we go. So that answers that one there. Now, what happens if a portfolio landlord's existing properties do not meet lending criteria? That's an
They
interesting
won't.
question.
They won't lend you any money,
There you go.
basically. So what happens if a portfolio? Just repeat the question for me. What happens if a portfolio landlord's existing properties do
Do
not meet
not.
lending criteria?
Yes, yeah, that's correct.
Okay, so do they mean if their properties they already have don't meet their criteria, then it doesn't matter?
Okay.
Right, in terms of what's the criteria. So are we talking about if it fits their stress test? Obviously, if the whole portfolio doesn't fit their stress test, they won't
Mm.
lend. If the properties that you've got in the background, let's say you've got a property that is a leasehold that lender wouldn't lend on, that doesn't matter. They'll lend on the purchase that you're doing, but they're not lending on the background. All they need to happen for the background properties is that it fits their overall stress test.
Okay.
It doesn't matter if their properties are outside of their criteria, for argument's sake. If it's a construction type or something like that, they're not fussed about that. They're only
Mm.
fussed about lending on the new property as long as the business model itself makes sense.
Right. Okay. Well, you covered both sides there, so hopefully that has
Hopefully,
answered the question
yeah.
for
I
everyone.
can't.
Yeah.
I'm not 100% certain that we know exactly what the question is alluding to, but hopefully that explanation answers both.
Yeah, definitely. All right, then. Well, let's move on to the last question here. So, what types of properties can be included in a portfolio landlord mortgage? Are there any limitations here?
Okay, so again, guessing what the question here is. If it's
Yeah.
limitations to a new purchase,
Time.
then generally any property restrictions will be across the board for buy to let. So whether or not that's portfolio or not, the
Mm.
things that you really need to be looking out for that could flag up as a problem or cause you aggro throughout the purchasing process are things like non-standard construction. Yeah, so things like timber frame, concrete construction, thatched roofs, anything that isn't really conventional will be potentially be on a lender's radar, or they might not like it. So worth flagging up. New builds, they can come with bigger deposit requirements. Leasehold properties with a really short lease, some lenders don't like those. Things like holiday and student lets, again, they're just going to be more difficult to secure because of the sort of higher turnover of the rental situation, and it might not be in a lender's risk appetite. Anything, like I say, anything other than a conventional property type is going to be something that you probably want to bring to the table with your broker before you start to progress and before you start to spend money on, because you really need to make sure that the lender that's being approached is going to be happy with those sort of finer details before you get committed, because it's
Mm.
it can be a straightforward process if you get your ducks in a row, but my god, can it be dragging someone down a garden path if you don't.
Okay. So a key pointer there, an important note to end on, really. Now we've covered quite a lot there. We will be back for a part 2 episode. There's more questions, can you believe? But have you got anything else you'd like to add for now?
Um, no, I suppose just on the last point there, it can be as
Mm.
difficult or as easy as you like. It really just does depend. We still get situations now where we have to go away for hours and make sure that we're coming back to to the table with everything that could trip us up, because
Mm.
it's a new situation. Every situation is different. So, I imagine most people that are portfolio landlords have probably got a broker. They probably know what they're doing, but it's key to make sure you are dealing with someone that has got experience within that space. Otherwise, you're going to be flogging a dead horse.
Okay. Well, a key note to end on there. Thank you for that. And Paul, we'll catch you on our part 2 episode.
Thank you, Tessa. Speak to you soon.